This learning guide is on Ichimoku Clouds. It is a beginner's guide for an overview of STA learning. What we're going to look at in this presentation is an understanding of the Ichimoku cloud system, how to apply clouds in technical analysis, what STA learning resources are available to you, and we're going to look at case studies and practical applications. So let's start the understanding of the Ichimoku cloud system. This was originally developed in the 1930s as a new technical analysis tool. The inventor, Shodo, a Japanese journalist, wanted a charting method that allowed traders to understand market balance at just one glance. And the purpose of the cloud system is to provide a clear picture of price momentum as it predicts price and resistance levels. I know that it looks strange, but let's try and break it down so it's a bit easier to relate to. So let's start off with the shaded area, which is otherwise known as the cloud. When price is below the cloud, that's generally perceived as bearish. When price is above the cloud, that's generally perceived as bullish. Now, the blue line is known as the turning line or conversion line, and that depicts short-term trend. So if price is below the blue line, that's seen as short-term bearish. If price is above the blue line, that's seen as short-term bullish. The red line is known as the baseline, and this gives you your medium-term trend. When price is below the red line, it's seen as medium-term bearish, when it's above the red line, it's seen as medium-term bullish. And lastly, the green line represents the lagging line. This confirms trend direction. So the green line above price is bullish. The green line below price is seen as bearish. So in summary, there are 5 components of the cloud system. The conversion line, which tells you the short-term trend. The baseline, which gives you the medium-term trend. Cloud A and B form the cloud and therefore can offer future support and resistance. And the lagging line confirms the trend direction. And altogether, these give traders a one-look view of market conditions. So let's have a look at the core components and its calculations. Ichimoku lines consist of 5 different lines. The first one we're going to look at is the turning line, Tenkan-sen, sometimes called the conversion line. Now, the formula for this is the highest high over 9 periods added to the lowest low over 9 periods. They are added together and divided by 2. The trend signal is generated when price is above the turning line. So if price goes above this blue line on this particular chart, that is seen as short-term bullish for the market. When the turning line crosses above the baseline, which is red on this particular chart, that is seen as bullish, and a bearish crossover is seen when the blue line crosses below the red line. A steep slope indicates strong momentum. A flat line suggests consolidation or a lack trend. This line is the standard line, sometimes called the baseline. The formula is as follows. It's the highest high over 26 periods, which is added to the lowest low over 26 periods, and this sum is divided by 2. And how it works is is if the price is above the baseline, that is considered medium-term bullish. If it's below, then it's bearish. So we're going to look at the cloud. So cloud span A is formulated in the following way. It is the turning line plus the baseline divided by 2. It's commonly depicted as a green line. It just forms one edge of the cloud. The other one is obviously cloud span B. So when the cloud span A is above cloud span B, the cloud is bullish and it's often shaded green. If it's bearish, then it's often shaded red. A steep span A indicates a strong short to medium term momentum. Let's now look at cloud span B. So it's made up the following way. It's the highest high over 52 periods added to the lowest low over 52 periods, and that is divided by 2. Now, cloud span B, it forms one edge of the cloud, which together with cloud span A provides the shaded area on the chart. The cloud acts as support and resistance, but because this is slower to react than span A, it often marks the stronger support or resistance levels for the market. The lagging line is the last component of the cloud system, and it is plotted 26 periods behind current price and is used to confirm trend direction by comparing today's price to past price. I particularly find this very helpful. The lagging line above past prices confirms a bullish trend. If it's below, it confirms a bearish trend. It's very useful to validate signals for the other cloud components. For example, a bullish crossover of the turning line above the baseline is much stronger if the lagging line is also above the price. One of the things that I really like about it, it is just a simple visual confirmation of trend direction. Let's look how we interpret these key signals on the cloud chart system. Very simple way is to look at the crossover between the price and cloud. And in this example, we've got a Bitcoin weekly chart. And we can see early in 2024, price broke above the cloud, and this signaled the start of a renewed bullish trend for the market. We can also see midway through to 2024, prices dipped back towards the cloud where they were well supported and the bullish trend resumed. We are now going to look at further ways of applying the cloud system in technical analysis. Very simply, the cloud reveals trend direction. So while it's above a green cloud, it's bullish. When price is above the green cloud, it's bullish. And when price is below the red cloud, it's bearish. The slope and the thickness of the cloud indicate the trend's strength. If you've got a steeply ascending cloud, it's a strong bullish momentum. If it's a sharply descending cloud, it's strong bearish momentum. Let's look at a few trade setup strategies and how we would enter a market or indeed exit. So traders use signal confirmations like crossovers to determine optimal entry points for trades, and cloud breakouts are used by traders to identify pretty effective exit points in trade planning. You can quite easily use this for risk management to place your stop levels beyond the cloud boundaries. You can use them to take profit, or indeed use them to improve your risk-reward ratio. Reader's original books lay the theoretical groundwork for understanding the system deeply. However, modern analytical guides are available, and the recommended textbooks from STA Education are Ichimoku Charts, An Introduction to Ichimoku Kinko Clouds by Nicole Elliott. Nicole actually introduced me to the cloud system via one of her talks to the STA at one of our meetings. The other textbook that is recommended by STA Education is the book by David Linton, Cloud Charts, Trading Success with the Ichimoku Technique. STA members have access to our extensive library stored at the Barbican Library. And if you would like to get access to those textbooks at that library, you can do so via your STA membership. Students and members can review academic and market research papers and regularly learn about new Ichimoku cloud strategies and market analysis. These can be found in previous copies of our journal. We are now going to look at a few case studies and practical applications for trading with your cloud systems. I'm going to give a really simple example of scalping short-term trading. This occurs when price is above the cloud. The original signal was given here on the meta chart, it's a daily chart, when the turning line broke above the baseline back in early May. It wasn't until towards the end of May that we saw price actually break above the cloud as well, and that would give you your entry point. When the turning line breaks below the baseline towards the end of July, that was your signal to exit the trade. This is another example of scalping on a short-term trading system. We're using the cloud. A simple crossover between the conversion line above the baseline gives you your initial buy signal in the middle of 2023. You'll note at that point that the cloud is red. So it is a slightly riskier way to do it. Better for the confirmation to wait for the confirmation that once the cloud turns green. Now you can use this one of two ways. You can either enter once the crossover is seen, but just cautiously, and then you can add once the cloud also turns green, or you can simply wait until the cloud turns green to action the trade. This is probably one of my favourite trade setups using the Ichimoku cloud system. Step 1, you wait for the lagging line to break above the cloud. This alerts to a possible trend change, and we see this in mid-2022. Step 2, you see price break above the cloud. Step 3 happens when the conversion line breaks above the baseline, and step 4 happens when the cloud turns green. We would recommend that you always wait for the candle close and use the cloud as a dynamic support. But I found this to be a really effective trade setup to watch for. I personally quite like to use the Ichimoku cloud system together with Fibonacci retracements. So in this particular example, we saw that in early 2025, the market was starting to retrace, and in April, the market has held above its 61.8% retracement. Now, if you then apply the cloud system and use it to watch for the turning line breaking above the baseline, that will give you an early indicator that probably that retracement level is going to hold and the market is ready for its next move higher. So that I find is a really effective way to use the cloud system. The conclusion is to better understand the cloud system, try to understand the key elements of the Ichimoku components. Use proven trading strategies based on the cloud system for better decision making. Leverage your learning resources. The STA have got books, courses, tutorials to deepen your knowledge and skills. And obviously, practice using them. If you would like to dive deeper into the cloud system or just broaden your understanding of technical analysis, please head over to www.technicalanalysts.com/education for more information.